for export.
Should African nations trust their own or look abroad for help? That question is now at the center of a storm shaking Ghana's mining industry after a move that stunned both the public and industry insiders. Just days ago, the Ghanaian government abruptly canceled a $1.2 billion agreement with Rockshore, a Ghanaian-owned mining company. The deal was meant to be a model for local capacity, resource sovereignty, and economic independence. Instead, it's gone, replaced by talks with foreign corporate giants. Why would Ghana walk away from its own and hand over the keys to outsiders? And more importantly, what does this mean for Africa's long struggle to control its own wealth? Ghana holds an estimated 900 million tons of bauxite reserves, the seventh largest in the world. For those who don't follow mining, bauxite is the primary source of aluminum, the metal that builds airplanes, powers electric cars, and forms the skeleton of modern construction and technology. In other words, bauxite is not just red earth. It's a ticket to industrial wealth. In 2024, Ghana hit a record 1.7 million tons in bauxite output, and production is projected to reach 2 million tons by 2025. The industry is not shrinking, it's booming. On paper, Ghana is well positioned to dominate the global aluminum market. That's what made the Rockshore deal so promising. The canceled agreement centered on the Nahin Hills, home to 376 million tons of bauxite, nearly 40% of Ghana's total reserves. These are not ordinary deposits. They have a low silica content and a favorable alumina to silica ratio, meaning they're cheaper to process and produce higher quality aluminum. The structure of the deal was straightforward. Rockshore would own 70%. The state-run Ghana Integrated Aluminium Development Corporation, GIADEC, would take 20%, and the government would retain 10%. The joint venture even had a name, the Asante Bauxite Company. But this was more than a mining operation. It included building a domestic aluminum refinery, a critical step in turning Ghana from a raw material exporter into a full-scale aluminum producer. This was supposed to be the big leap, creating jobs, keeping profits in country, and moving Ghana up the value chain. Then, without warning, the government pulled the plug. Officials cited a fatal flaw. The lease with Rockshore had never been ratified by Parliament, a legal requirement under Ghana's mining laws since a 2019 Supreme Court ruling known as the Exxon-Cubic decision. No ratification, no lease. That gave the Ministry of Lands and Natural Resources the authority to terminate the agreement. The legal reasoning is clear, the timing, less so. Almost immediately, reports surfaced that Ghana was courting Emirates Global Aluminium, EGA, a Dubai-based mining giant, and a major Chinese firm. Negotiations, insiders say, are already in advanced stages. Extraction at the Nahin Hills could begin as early as next year. On paper, these companies bring technical expertise, capital, and global market access. But history has shown what can happen when Africa hands its resources to foreign giants. And that's where this story turns from a legal dispute into a test of sovereignty. If Emirates Global Aluminium, EGA, does secure the Nahin Hills contract, it won't be their first time in Africa's bauxite sector, and the last attempt left a cautionary tale. Back in 2022, EGA explored a deal in Ghana, but backed away, reportedly to avoid upsetting Guinea, where it already held a lucrative mining license. For a while, it seemed Ghana wasn't part of their plans. But then, Guinea revoked that license. The reason? EGA had failed to build an aluminum refinery it had promised as part of the deal, a refinery that was supposed to change Guinea's economic future. Instead, EGA kept exporting Guinea's raw bauxite to feed its own global operations, pushing refinery deadlines further and further until the Guinean government finally had enough. The license was pulled. The promised jobs and industrial growth never came, and Guinea was left with little more than environmental scars and unfulfilled commitments. Now, with the Rockshore deal gone, EGA is back, this time in Ghana. And for many observers, the question isn't whether they can mine bauxite efficiently. It's whether Ghana will see more than just the raw ore leaving its shores. This isn't a one-off story. Across Africa, the same cycle repeats. Foreign companies arrive with promises of industrialization, job creation, and technology transfer. But the reality often looks different. In Mali, Barrick Gold has operated for over a decade, yet government officials say it hasn't paid taxes or royalties since 2021, an unpaid bill approaching $500 million. In Nigeria's Niger Delta, decades of oil extraction by Shell and Chevron have left farmlands poisoned, rivers slick with oil, and fishing communities devastated, while billions in profit flowed overseas. When Africa's mineral wealth leaves in its rawest form, the countries supplying it lose control over pricing and remain at the mercy of global market swings. They become price takers instead of price makers, locked into an economic role designed during the colonial era and rarely escaped since. Critics of the Rockshore cancellation argue that Ghana's government had a chance to build real domestic capacity and instead traded it for foreign capital. But supporters of the pivot counter that large-scale mining and refining require massive investments, often in the billions, plus advanced technology and highly skilled engineers. Most African nations don't have these resources at scale. Even exploration can cost hundreds of millions, with no guarantee of success. For governments already stretched to fund roads, schools, and healthcare, the risk can feel too high. This is the trap. Without the tools to process their own resources, African countries turn to foreign firms for help, but in doing so, risk repeating a cycle of dependency. Ghana's leaders argue this is a calculated move, blending foreign expertise and investment with state oversight through GIEDC's continued stake. If executed properly, they believe it could give Ghana both the capital it needs and a foothold in the global aluminum supply chain. But as Guinea's experience shows, a contract on paper doesn't guarantee delivery in reality. The stakes are enormous. This isn't just about one mine. It's about whether Ghana can write a new playbook for African resource management, or whether it's about to rehearse the same old story. If Ghana truly wants to escape the historic trap of resource dependency, the blueprint isn't a mystery. Economists, industry experts, and even some African leaders have been pointing to the same solutions for decades, but they require political will, strategic patience, and a shift in mindset. First, every mining deal should mandate local value addition. That means refineries, smelters, and factories must be built on African soil, not as vague promises in corporate brochures, but as binding, enforceable obligations with timelines, penalties, and independent oversight. This alone could transform raw bauxite into finished aluminum within Ghana, creating jobs and retaining billions in revenue. Second, there must be real technology transfer. Too often, foreign firms keep high-level technical knowledge locked away, leaving locals in low-wage, low-skill positions. A serious deal should include training programs for engineers, geologists, and plant managers, ensuring that within a decade, Ghanaians can run the entire value chain without outside help. Third, governments need to pool resources regionally. One country alone may lack the capital for large-scale processing, but a West African consortium could change the equation. Imagine Ghana, Guinea, Sierra Leone, and others building a shared aluminum hub, spreading the costs, the benefits, and the expertise. Some African nations are already trying to flip the script. In the Sahel, leaders in Mali, Burkina Faso, and Niger have begun rewriting contracts, demanding higher royalties, local processing, and the end of exploitative terms. Uganda's President Yoweri Museveni has pushed back on deals that export unprocessed minerals, insisting on building industries at home first. But these policies are not without risk. Foreign investors may walk away. Projects may stall. In the short term, it can mean slower growth. Yet, as history shows, the alternative, endless dependency, is far more costly in the long run. By courting Emirates Global Aluminium and Chinese firms, Ghana is betting that the benefits of foreign investment will outweigh the dangers of dependency. Supporters say this is the fastest route to building world-class facilities and securing a place in the global supply chain. Critics warn it's a replay of the same pattern, outsiders taking the lion's share while Ghana watches the real wealth leave by ship. The truth is, both sides have a point. The outcome will depend entirely on the fine print of the new deals and the resolve of Ghana's leadership to enforce them. A mining agreement that looks good in year 1 can turn hollow by year 5 if promises aren't met and enforcement is weak. Africa has the resources. It has the talent. What it often lacks is the leverage and the patience to build industries from the ground up. Whether Ghana's decision marks a step toward modern industrial capacity or another chapter in the continent's long history of extraction will depend on what happens next. Because in the end, this isn't just about bauxite. It's about who owns Africa's future: Africans themselves, or those who see the continent as a warehouse for their own prosperity. What are your thoughts on Ghana's decision? Do you see it as a bold step forward or a dangerous slide back into dependency? Drop your thoughts in the comments. Support our work by liking this video, and make sure you subscribe so you don't miss our deep dives into Africa's fight for true economic independence.